Welcome to Innovation Dialogue. I'm Diana Ding.
My voice.
My story.
My dream.
Innovation Dialogue.
We are encouraged by their story.
Very powerful panel, as you can see. The topic is exits. What's next for IPOs and M&As? I think they're quite different, actually, and we've seen quite different behavior recently here. But first, I'd like to introduce the panel, and I can have each of you say a few words after I introduce you about who you are, what you do, what your funds do, what kind of investments and companies you're involved in. Next to me is Stephen Cheng. He's the Lenovo Corporate Strategy Officer. Next to him is Joydeep Bhattacharyya. Tried to say it as perfectly as possible. Partner with Canaan Ventures. And next is Jack Jha, who's a partner with GSR Ventures, and Jon Sakoda, a partner with New Enterprise Associates. So why don't we come back the opposite way? Maybe Jon, you introduce yourself, and come back Jack and Joydeep.
Is this on? All right, perfect. I'm Jon Sakoda. I'm a general partner at NEA. We're a 40-year-old venture capital firm, probably best known for being a multi-stage global venture capital fund. We raise some of the largest venture capital funds in the industry. Our most recent fund was a $3.3 billion venture fund, and we're still making very early-stage investments in companies at Series A and Series B level, but I think what is somewhat unique about our model is that we do like to increase and substantially increase our investments in companies as they grow, and we do actually even meaningfully participate in the IPOs and the public offerings of our portfolio companies. We invest in software, we invest in internet companies, and we invest in healthcare companies. And I'm excited to be here. Thank you for having us.
So I'm Jack Jha. I'm a partner and special advisor for GSR Ventures. But I'm more of an entrepreneur, actually. I'm being a 4-time entrepreneur, and I'm also running a lifestyle app company called Musely today. But GSR have done a lot of consumer internet investment in China, probably over 100 different companies across 5 funds. Our biggest claim of fame is really taking what is big in the U.S. market, started in 2005, and then find that team that can replay that big market play. So the first company we invested in was this company called Big Intelligence, it's in Chinese, 大智慧, which is Bloomberg of China, with a probably 15 years time gap. And then the third company we invested was 去哪儿, where are you going in Chinese, and that was Kayak of China, and then ended up to become a multi-billion-dollar company. More recently, we led the DD investment when the company was worth less than $10 million, and I think for most people know, probably 5 years later, today we're more than $50 billion in valuation. So we did a lot of crazy things, like investing last year with a few universities, Beijing University students riding bicycles, sharing, and when they were, looking for seed one investment in January, nobody understood what that business was, and so we just put money in. We thought we should, and then in that 1 year, from C to A to B to C, I don't know how many letters now that company is a multi-billion-dollar valued bicycle sharing company with bicycles, yellow bicycles everywhere in China, literally in 1 year. So the capital certainly accelerated a lot of these investment, but I'm not sure the IPO story is as interesting as some of these company growth.
Hello there, this is Joydeep. I am a partner at Canaan Partners. We were founded 30 years ago, and We just actually celebrated our 30th anniversary 2 weeks ago. We are an $800 million fund and invest in Series A and B, early stages. But as Jon mentioned, we also believe in buying up ownership and exit late, only at an IPO or M&A. So this is an interesting topic for us. We're fortunate enough to be part of some interesting IPOs like Lending Club a few years ago, and Kibam, one of our portfolio companies, were recently acquired. So really looking forward to this discussion.
Hi, I'm Steven from Lenovo. I work in the corporate strategy department. Basically, there's a 4 business group in Lenovo. The first one is PC and tablet. The second one is mobile phone. Third one is server and storage and networks facilities. The last one, but not least, is incubating and investment part. Lenovo, as you all know, is a 34 years old company. We do, incubating and acquire the solution companies. So we're actually providing very strong force in the M&A market. Yeah.
I think these guys are a great group to hang out with, all these stories of success. So 2016 in the US was a pretty rough market for IPOs. I think it was the worst one since 2003. There was only 4 companies of $1 billion or more that came out. I think in 17 we were hoping some of the ones earlier, Snap or Cloudera or Blue Apron could do something, but they haven't. M&As, on the other hand, we have seen a lot of M&A activity. Most recently, I think, shocking, but if you shop there at Whole Foods, maybe you love the Amazon IPO, or maybe, I don't know, it's an interesting one that woke up a lot of people in new kinds of ways. I certainly see my food prices going down, so that's a benefit. But the other markets, such as China, obviously, in their IPOs and M&As are moving differently. I think the question is, here in the U.S., initially, maybe, Jon, you can start, and we can get all your thoughts. What do you think might kickstart the IPO market here? And, versus, do you have any other comments on, IPOs elsewhere in the world and so on?
Well, I think the IPO market is maybe more diverse on the tech side than maybe people read about in the media. I think the headlines are largely driven by very large, almost mega cap IPOs, and so every so often, once every 2 to 3 years, is a great, fantastic mega cap IPO, which completely changes how people feel about IPOs. You had Facebook 5 years ago, you had Alibaba a few years ago. I think people are waiting for the next one. There was a lot of hope that maybe Snap would be one of many of a cohort of companies that would come public, which would, again, make the IPO numbers look more spectacular than they have been. But I do think you have a nice pipeline. You have Uber and Airbnb here in the U.S. You have Didi in China. There is a really nice crop of private companies, which ordinarily would not have stayed private this long, if not for the accessibility of the private capital markets. But ultimately, they are all destined to become public companies in a relatively short period of time, and when they do, they'll be mega cap IPOs, and I think they'll make up for some years where we had maybe lackluster numbers. I do think there still are very, very healthy IPO markets for great companies, and I think companies are being smarter about staying private longer to make sure that they're ready to access those markets, and I think the valuation environment is actually quite sane. The more mature and the faster growing and the more profitable you are, the better your multiple, and I think that wasn't always the case. There used to be a time and place in the IPO world where companies that were a little bit smaller, that were burning tons of money, were getting better multiples than the more mature companies, and if that sounded irrational, it might have been, and I think the markets have kind of corrected for that pretty quickly, so companies are staying private longer, becoming more mature assets, and going when they should go. And I think so long as that's the case, there will always be receptivity to great private companies. So I think it's it's not as bad as the numbers might reflect.
Yeah, I want to reemphasize what John said here, which is the diversity of the pipeline and the past exits in the last 12 months. So if you just look at Blue Apron and Snap, which are probably the headline grabbing, then you are actually discounting a lot on the things that have happened on the software and the enterprise side. I'm actually a little bit biased because I invest only in the enterprise, right? And if you look at companies like Alteryx, Cloudera, Appian, these are companies that have shown profitability, predictability, and even Okta, by the way, and the stock prices have traded up. So I don't quite agree that the IPO market has not completely done well. I think the market is in a very interesting state today where it's much more rational than it used to be, and it's rewarding the haves and punishing the have-nots much more than what it used to do before. So that's quite interesting. I mean, that's great, I think, and healthy for the long run.
I actually have a different perspective on this. My second company was a .com. Interwoven was a .com company. So from 3 engineering, we were writing the first line of the code to IPO was 3 years. We were rushing to IPO, right? Everything we do was about going IPO. The mindset was very different back then because that was the only way to get additional money. When you are worth $300 million or more, if you don't go IPO, there's no way to get funding anymore, right? Which I think today that completely changed thanks to Sarbanes actually. Started this whole thing we thought it was the negative thing. It might be good for innovation because we're forced not to go IPO, and then the later stage investor comes in, jump to the other side of the IPO line and start to have PEs and hedge funds and even your traditional LPs are investing directly in deals, which really helps these companies to innovate, right? Because we all know under the Wall Street eyes and companies will have a hard time to innovate, right? A couple of weeks ago I was at the DCN CEO Summit and they're talking about the $100 billion SoftBank Vision Fund, right? So their investment is minimum $1 billion, whatever that means, right? If you want my money, you need to take $1 billion. So then you can really think big, think long, and so why go IPO, right? If you don't have to, and if you can cash out the founders, the founding teams can cash it out enough to make their life good enough, and there's really no need to go to Wall Street. And that's for the U.S. For China and market is actually different. We're seeing if the local company wants to go IPO because the market is very hot. There's a company that I'm pretty familiar with. It's called Meitu, which is basically an app making women beautiful so you can have selfies. And that company went IPO in Hong Kong stock market, and it's worth $7 billion. So why not if you can actually get that kind of valuation? And that's also true. A lot of the Chinese companies who are listed on NASDAQ are now basically delisting themselves and finding private equity firms and restructure them and then relist them in China or Hong Kong. And so that's happening also at the same time.
A lot of dynamics. Stephen, any thoughts?
Yeah, I want to double click on the post-IPO pricing part. I think the post-IPO pricing also influenced quite a lot to the behavior of entrepreneurs, whether they choose to IPO or through M&A process or live as a standalone profit company. Taking Cloudera and Hortonworks, for example, Lenovo have a deep relationship with those two companies, and even though we're seeing the trend that in the future the public cloud are going to dominate, but for certain industries like finance and healthcare, there still preserve large quantity of private cloud. So this kind of circumstances are perfect for Cloudera and Hortonworks, MyPar, this kind of company, to deploy. But the Wall Street are not betting on the current things. They're betting on the future. And this kind of technology is also kind of hard for the analysts to understand. So eventually, it's about the time to the technology core, to focus more on the future technology, or at least, think along. Thanks.
Right. So I guess that begs a question. I mean, how do these portfolio companies behave? There's prepping for IPO, or there's considerations of do you plan IPO and pursue a strategy that way? Or do you plan for M&A? Do you look for your corporate acquirers? Is that an easier path to take? Or any of the other types of dynamics going on? There's regional implications. Several panelists have mentioned China versus the U.S. environments here and how they're different. So I don't know if anybody wants to take that one. It's kind of a big question, but it's really about the companies and the environments and the different choices you have on which way to pursue growth and pursue your exits and strategic objectives as well.
So I can take that from the perspective of enterprise companies because I'm just more familiar with that. And typically enterprise companies tend to be the mid-cap kind of companies, $1 billion to $3 billion, something like that. And if you think about that, even if you think about the Vision Fund or some of the larger investors, they're from a $100 billion fund, the minimum check size might be a $500 million, $700 million check. And that would not move the needle, or rather, an investment in this kind of a mid-cap exit with a $2 billion market cap would not move the needle for the Vision Fund or any other such entity. So although we are seeing on the mega cap side, things might be changing, companies might be staying private longer, on the enterprise side, companies need to start prepping for some kind of an exit, some kind of an IPO, the moment they're in the billion to 2 billion valuation range, or even before that. And when you think about, because you cannot, yes, AppDynamics got bought by Cisco, but then we have to understand they were actually going to go public, and it was preempted by Cisco, right? So the point is that you can never bank on M&A, and you always have to prep for the IPO, and for prepping for an IPO, it's at least an 18-month, if not a 2-year process. You need to get the CFO in the right place. You need to figure out your quarters are coming in from the sales front a predictable manner, because you don't want to miss the quarter right after the IPO. So there are a bunch of different things that needs to be done for about a couple of years before you get there. So I think on the enterprise side, I don't see a lot of change based on all of these new changes in the market, but probably from the consumer side, it feels like it's different.
Well, I think maybe the common similarity is scale matters. I mean, all the acquirers are actually just much, much bigger on the enterprise and the consumer side. Their P&Ls are enormous, their market caps are enormous. So to move the needle of Apple and Facebook and Amazon, you got to be big. To move the needle of Oracle and IBM and Microsoft, you got to be big. I mean, there's a haves and have-nots world in the M&A market, where if you're a small tuck-in acquisition, there's a lot of those deals getting done. And if you're a big, meaningful player, there are a lot of those deals getting done. There's nothing in the middle anymore. So I think all the companies now have to get big and get relevant, and that means they're either getting ready for IPO or they're getting ready for larger cap M&A. But it's really the mid-market that's fallen out. There aren't a lot of volume and deals done in the kind of the 150 to $500 billion range like there used to. I mean, that used to be kind of the heart and soul of the M&A market. But I think if you talk to the people that run the corp dev groups at Apple and Google and Microsoft and IBM and Oracle and Cisco, they'll all say, look, at some point, we're all trying to play the same game, and we've got to move the needle. And our P&Ls are huge, and in IBM's case, if we've got 20 plus quarters of declining growth, we're not going to fix that problem by buying smaller companies along the way. We've got to make bigger moves.
Any other comments, Stephen?
Yeah, I want to add something on Lenovo's perspective. for a global company, the most difficult thing to deal with is to address regulatory and country-wide difference. So a global company, if it wants to expand into other countries, it's actually quite difficult for the company itself to organically generate such ability, especially dealing with the country-wide perspective. So I believe that global company have the appetite for, through M&A acquisition rather than develop itself. The second part is we are trying to find some interdiscipline verticals which we're not that familiar with. So for that kind of solution, it's more easy to acquire or integrate that kind of solution in the current system. So,
thank you. Real quick question, because we're out of time. Will this year, meaning the next 12 months, or say 2018, be a better year for you personally with respect to exits or M&As, IPOs, any kind of exits? Are you optimistic, or is it a longer road to haul? Do you see the environments changing? What's your personal situation and with respect to your investments in portfolio companies? I don't know if anyone wants to take it. Go.
I think we'll probably all have the same answer, which is, we all invest in companies that are growing 50 or 100% a year. So every year it looks brighter, and every year we get a little bit closer to liquidity. So I think in our business next year always looks better because our projections are always so rosy. And we I think maybe are fortunate when you have a diversified portfolio. There's at least some percentage of your crop that's going to cross the $100 or $200 million threshold if you just can keep them alive long enough. So I do think next year will be better than this year.
Yeah, so for early stage investment firms, I think we actually have a lot of exit already, even without having to go IPO, because the later stage fund coming in, they will buy our shares. So effectively, that's our IPO. And so we don't have a lot of your typical IPOs other than in the China and Hong Kong market. In the US, even we're a kind of USD fund, that hasn't really been an issue for us. So it's going to continue to like that. But one thing I do want to say is this conference itself is actually a good way for mid-sized, kind of a M&A type of opportunity to happen, because there are a lot of Chinese PE funds are looking for U.S. opportunities. And I actually have two, my personal angel investment have done in this year. The two companies were bought by Chinese PE fund. One of them is called App Loving, which is a tech ad network and advertising for mobile, and the company would really just fundraise, Series A, angel round 5 years ago for $4 or $5 million, never raised another round, and all of a sudden, and they never thought they would actually be bought by a Chinese PE firm, and they were bought for almost $1 billion, and I think that PE fund is going to wrap it around and probably relist it, in China.
Yeah, I think it's slightly contrarian point. I think it does not really matter for us as early stage investors whether this year is going to be good or bad, because when you're investing in the early stage, you're taking really a 10-year, 15-year view and looking to support the company through that whole phase. So yes, we have been in business for 30 years. There were ups, there were downs. The next 30 years, there will be ups and downs. So it doesn't quite matter from our perspective what the next year looks like, but as long as the fundamentals in tech is strong, and that provides the benefits.
Right. Stephen?
Yeah, I'm actually kind of conservative about that part because Janet Yellen just announced that Feds are preparing to paring their balance sheet. So it's not a very positive influence towards the stock market. So maybe in a year or two, the total stock market performance may not be, as good as this year from the macro economic perspective.
Got it. Well, all we can do is keep building value, I think, and eventually seems the key point is it will be realized sooner or later. But thanks everyone for participating, and we appreciate the audience's listening.
Thank you.